sale leasebacks, girls soccer, the data center industry. We're talking about it all with Ryan Sullivan, Managing Director with Rackhouse. Next. Ryan Sullivan, awesome to have you here.
Honored to be here.
Yeah, doing this, and we've been trying to do it for a while, so thank you for joining us. You have been in the data center industry now for a long time and know the space very well, so I'm excited to get to just hear your thoughts on the market, some of the things that are changing. I think we both can agree that the last 5 years in this space has been dynamic.
It's been huge.
And, think that, the next 5 will probably be the same way. So you're a managing director with Rackhouse here in Dallas. Obviously, you serve the United States. But talk about your background in the industry and how you got into the data center space.
So, I've been with Rackhouse now for 3 years. And I started in the data center industry with Digital Realty.
Yeah, sure.
Back in 2006, 2007, in what was the early days, it felt like, but Digital at the time was growing their business by acquiring existing data center assets, telco assets across the country. And I joined and began underwriting those new acquisitions, underwriting new leasing opportunities, and this was all post-IPO, but we were still very young.
Yeah.
And
and I think, too, at that time in the space, what's interesting is, that's really where you saw a lot of companies owning and operating their own data centers. So this whole idea of actually outsourcing that to credible partners like a Digital or other companies was really new. And so you were right in the middle of that.
Yeah, and I saw a lot of, how to put a deal together there.
Yeah.
And, obviously from 2007 to 13 when I left, there was a lot of growth that occurred. Very quickly moved into more of the development route and, acquiring land sites for new development. So I got exposed to, site selection and zoning and entitlements and design, construction, engineering, operations, and eventually was managing a 2 to 3 million square foot portfolio across the central U.S. until I left in 2013.
Okay. And then, talk about how your role has changed now as far as, where you're focused, where you were focused then and where you are focused now.
Well, there's a little gap in my career from 13 to 15 that, it's probably very important to my path to the space I'm at, or to the point I'm at today. So I left Digital to join a group of local investors to try to do it on our own.
Yeah.
And we had a great group of guys. We had a lot of fun, very hungry to get into the space and kind of be a little more entrepreneurial. So I left in 13 to join that team. And we raised a little money, bought land, got it entitled, and then tried to raise the larger amount vertical equity to build. And through that process, got exposed to capital markets and got exposed to a lot more people in the industry that are outside of that Digital umbrella.
Sure.
So I think, personally, a lot of growth occurred during that process and learned a ton.
Yeah.
And had a lot of fun.
Yeah.
And anyway, the deal didn't work out like we originally planned, obviously, but we closed the book on the development deal when we recognized that we could make a land play and do all right.
Yeah.
So made a little money and it was time to go get a job. And at that point, I got to Lincoln, or Rackhouse specifically, at a time when Rackhouse was beginning to kind of change their model from more of a services platform to an investment platform. And that just worked perfectly within my skill set.
Yeah.
With the Digital experience and then what I experienced with the development deal here in Dallas. So made a deal with Rackhouse to come on and join Martin Peck, who you know. And the rest is history. I mean, we've had a lot of activity since that time. It's been 3 years. And, now we've acquired 13 properties across 9 markets.
You've been busy.
1.7 million square feet within the portfolio. And still have an appetite to go get more. And so from the early digital days to now,
Sure.
A lot's changed.
Yeah.
I've grown up a lot, but had a lot of fun.
Yeah.
And it's, we're blessed to all be in this space.
Sure. I tell people that all the time. Earlier this week, I was just talking about the opportunity to be in a market that's so dynamic and has changed so much in just the last couple of years, let alone to, when you started at digital. One of the things that you all have been successful at is this most recent acquisition that you had. And it highlights a trend, I think, that's taking place in the space. We've talked about it before. In fact, I heard you, I think it was last week, maybe in Chicago, talking about it.
Yeah.
But companies 10, 15 years ago, the way they looked at their IT infrastructure was obviously very different than they look at it today. Those companies back then really preferred to own and operate their own data center facilities. A lot of that is around control, and their desire to not let such an important part of their business and IT infrastructure out of their hands and into someone else's. Sure. That's changed significantly, but what is really left over from that time period are, throughout the United States and other countries as well, data center facilities that are aging, that are not necessarily meeting the business needs that companies have today, and it creates opportunities for data center operators, investors in the space, to acquire those facilities and do something different with those. So you all did that recently with 3 different assets, one in Phoenix, one in Kansas City, and one here in Dallas.
We did.
So tell us about that. Tell us about why that was an attractive, play from y'all's side of things, and then how you position those assets moving forward.
So a little bit about that deal in general.
Yeah.
It was widely marketed by CBRE.
Uh-huh.
It was on the market for quite some time. And at the time, we had acquired, I think, maybe 6 to 8 properties at the time. And this was big for us. So we were extremely interested, knew we may have trouble raising capital for it, but wanted to make a run. And we were very diligent in the way that we underwrite a new acquisition, particularly around a very sound basis.
Okay.
So we want to go in at the right basis so that we can come out of the acquisition and compete aggressively on lease rate.
Yeah.
And, so because of that, a lot of times we get priced out of a deal by more aggressive operators who may underwrite something a little different than we do. And we got beat on that one. And, big deal. You get beat all the time.
Sure.
But we really liked the portfolio. So we hung around the hoop, and the selected buyer, spent, I think, months and months negotiating with the bank. Negotiating a lease is difficult. Negotiating a PSA with a group like that is difficult. And I think after several months, the seller, they realized that there was a real risk to close in a timely manner. And thankfully, we were still there. And, we're calling every month or two, checking in with the broker, checking in with the seller, forming those relationships. And at a certain point, it came back around, and, we got the call and asking if we are still interested. Of course we were, and we were able to go get it closed very quickly. Now, what we like about the deal, there's a lot. There's a lot to like. And, you talked about it before, but these enterprises have, you hear the word overbuilt all the time, and this is no exception, but they're just built to such a capacity that they never used. Yeah. And they're in great shape. Yeah. Tremendous assets across 3 good markets that we really like and are excited about, and, have space available to go to lease with right away. Yeah. So, the seller was using a portion of the space that they had developed. Now they're starting to adopt a cloud product and not necessarily see that it's so important to own and operate their own space, but outsource some of that. And so we go into the deal with a tenant immediately in a cash flowing portfolio that's got space available to lease. Yep. And what's not to like about that? I mean, as other developers scramble to bring space online in Dallas and Phoenix, we've got megawatts sitting there ready to go. So we're excited about it.
Yeah. Well, and it illustrates another 2 things that I think are really important. Number one, The important for user flexibility in the space today. One of the challenges with the technology market, the infrastructure market, the business climate is that it changes.
Right.
And with that change comes flexibility is really important. And I think companies are continuing to value that more and more today. And that directly relates to the type of environments they want to be in, whether that's a data center in a certain market, whether that's moving applications to cloud. So that's part of it. The other thing I think it really illustrates, and you brought it up, is we have now capacity in the market live today.
Right now.
And never before in our space and industry has timing and speed to market been as important as it is today because of the large hyperscale demand that's taking place and how that takes capacity off the market.
Sure.
So there's enterprise user deals that now can't fill, potentially where they thought they were going to be. So talk to us about the differences between, you all have also, as an example, acquired standalone assets in different markets. This was the type of opportunity where you acquired a portfolio. How do you think about those two differently, and what are some of the challenges with those?
Put very simply, it's time and effort and money. That's a very simple way to put it. But when you're looking at an individual standalone acquisition or an individual facility acquisition, it's a bit easier depending on the number of tenants and the size of the transaction. We've got several capital partners that can go close a deal of that size. On a portfolio, we've had to go out to the capital markets and raise that kind of capital.
Yep.
To raise that kind of capital is a little difficult at times, particularly for a deal with some heavy lease up. So.
Meaning it's just going to take time.
It'll take time, and there may be additional capital involved.
Yes, got it.
So for a smaller deal, that's a single standalone facility in a market that's understood, we can close a deal, and we've closed one in less than 60 days. On this one, that wasn't the case. So we went out and tested the capital markets. We've talked to a number of groups that are willing to get into the space or think they're willing to get into the space. So there were a lot of groups to go to and go through to kind of test out who's for real and who isn't.
Yes.
And, fortunately closed a deal with Principal, and they've been a great partner for us so far, willing to invest capital into the space as we grow and lease up. And are long-term, they've got a long-term outlook. So it's not a quick get in and flip it in a year type model. It's, hey, let's grow over time and invest capital where needed and make some deals along the way. It's just a portfolio deal is a little more complex than an individual transaction. And, you think about negotiating a lease or 3 leases with a seller who you haven't done business with before, that can take some time.
Yeah.
So if you were acquiring a portfolio that had in-place leases and a book of revenue, I think that's a bit different, too, than negotiating a lease for the first time with a user seller.
Yeah, well, and as the investment world changes right now in the data center space, I think right now we're seeing more and more investors interested in the space. I think one of the things that is different about the data center industry than other real estate asset classes you might invest in is the timing that it takes.
Sure.
And to get a deal done, these deals are more complex. They can be challenging at times, but it doesn't take many deals to make it, worth it. When you did this recent acquisition, you entered Kansas City for the first time, Phoenix for the first time. You're obviously very familiar with Dallas and familiar with those markets. But what are some of the challenges when you all look to enter a market for the first time?
So, I guess fortunately for us, entering a new market for the first time isn't seen as much of a challenge from an operational standpoint. Obviously, going into a new market, you've got to be comfortable with the market fundamentals and that the demand is going to be there once you close and bring space to the market for lease. Understand where market rates sit and if you can come to market competitively and aggressively against those groups that are already in the space in that market. But operationally, the benefit of Rackhouse is that we are a standalone business within a broader Lincoln Property Company. And the Lincoln Property Company portfolio or commercial platform stretches across 40 markets in the U.S., where we've got a services presence, whether it's leasing and management or asset management or development, in 40 markets across the United States. So that makes our little team here in Dallas much bigger. Sure. And we can stretch our arms across to any corner within the U.S. and make something happen, and leverage those resources on our behalf as we're closing a deal. So, as long as you understand the market, you're entering at the right basis and can bring space to the market competitively. Operationally, we're well suited to enter just about any of the top 20, 30 markets in the U.S.
Two of the markets that you've entered in, Atlanta in the last couple of years, Phoenix recently, you have quickly filled those facilities with actually a data center operator, INAP, which was formerly known as Internap. How did that deal come together? And it's a big win probably for everybody involved, because you acquire the asset, you lease the space. INAP is directly into that market and has capacity online. How did that deal come together?
It all started in Atlanta. So when we acquired the Atlanta facility last year from Coca-Cola, Coca-Cola was slowly consolidating into a smaller footprint in the space. So we knew immediately we were going to have space available to lease. Within our model, we're not a colo provider. We're not a sell it by the cabinet group. So we tend to focus on that colo provider, managed service provider, cloud provider type market. We want to provide the real estate solution for those groups. So that, when we closed on Atlanta, we immediately brought it to market post-closing. Surprisingly, got quite a bit of interest in it from the colo provider market. But the timing just worked out incredibly for INAP. They had a need for space, data center space in a core market of theirs. Atlanta was a key market for INAP and still is. And they are beginning to, make a concerted effort to right-size the real estate portfolio or get into leases that they can control their own destiny within rather than lease from other service providers. So, our deal was very attractive to them. We leased it on a powered shell basis with ready capacity to sell from a kilowatt standpoint. And they picked up some revenue on the way in. At the same time, they were beginning to migrate out of a headquarters location right down the street. So strategically for INAP, it makes a ton of sense to get the flagship type property that they can place their name on in the market from a data center perspective, but also relocate some personnel into as well. And it just met both of those qualifications. So we made that deal quickly. We're very fortunate to come together on that one. And as we closed it, we began to realize that their strategies and our strategies really mold well together. And where we both are at this time in our, history is, we're out there constantly looking for new data center acquisition opportunities that have some cash flow in place with some tremendous upside or room to grow. And they're looking to get out of the operator lease and into their own flagship type facilities that they can control their own destiny and own and manage and lease and sell colo and services into. So we got along very well together. And at the time, we had a few strategy sessions where we talked about what markets are next, where do you want to go, what can we do to help pave that road for you. And Phoenix was a market that came up. So and they had just extended long-term with an existing operator, Digital, in the market, but have a lot of success there, and we're filling that space at a good clip. So as the portfolio transaction came along and we were nearing closing, we brought that one to them, and fortunately, it checked all the right boxes, and we made a lease very quickly. And the rest is history. So that helped us sort of stabilize a portion of the portfolio early on and allowed us to take a little more risk in Dallas and Kansas City. And at the same time, kind of cemented our relationship with INAP to continue to pursue new opportunities with them.
As the market changes, data center operators continue to deploy hundreds of millions of dollars in capital to push the industry along. And because of the takedown of the space and the way it's changed, there's a lot more people, which we talked a little bit about earlier, a number of different investor groups that are looking at the space. Is that a good thing or bad thing for the industry? And what do you think some of the challenges are with new capital entering into the market?
So just the sheer size or number of new investors that are coming into the space is staggering. You've got now institutional private equity funds and insurance funds and pension funds coming into the space, foreign money coming into the space and playing a big role on these larger platform or portfolio acquisitions. What I think what it's doing now is, compressing cap rates on the core to core plus type deal, which, I think is probably a benefit to the market. It's a benefit to us as we look to exit certain stabilized assets. But at the same time, those groups aren't looking to invest capital and take risk on a value add play.
Sure.
Or a heavy lease up opportunity. So, as those groups are coming in, it's really more pushing out the early buyers of the stabilized real estate or data center real estate, like Carter Validus and groups like that who aren't as competitive anymore on, from a pure going in cap rate standpoint. What it's done for us really is given us more capital partners to go source deals to.
Yeah.
And that's been great. We've got, like I said, 13 different deals, 5 different capital partners, 4 different debt partners. 3 of those capital partners have never done a data center deal before. So this is their first test in the space, but surprisingly now there's so much money looking to come into the space that I don't think there are enough deals to go around. So it's an interesting dynamic today.
How are you seeing the deal structure changing, and we don't have to get into like the granular details, but if you look at where and how some of these investment deals were put together 5 years ago versus the ways they're putting together today, how are you seeing those change?
So I'll talk a little bit about deal structure first. Yeah. So, and won't hit on any actual details, but
you bet.
Typically the way we structure a deal is we'll raise outside equity, either private equity or pension fund type money, and as an LP to a joint venture to go close a single purpose entity and acquire real estate.
Yep.
As part of that structure, you offer a preferred return and then some IRR hurdle waterfall to get us into a promote.
Yep.
If we're successful in executing the business plan. So that's the way we structure deals. Now, deal specifics from 5 years ago today have changed quite a bit for the better, for groups like ours. Preferred return rates have compressed a bit. We've got deals where preferred return was in the teens at the time when we closed. And then, now after we've achieved a few successes, we're able to get in the, 8 to 10 range sometimes. Yep. But it all depends on the risk of the deal.
Sure.
The size of the deal.
Yeah.
And, how much spec development or lease up is in
play.
play.
What do you feel like separates Rackhouse from other companies, and what makes Rackhouse different? What are some of the core values of the company that you like that apply specifically to the data center industry?
Sure. So really, honestly, I think we're all kind of on this level playing field today, and the data center space is a little bit still in its infancy at its current state. Yep. So you've seen new operators come along who have had some success in the space that we now compete with. But where we can differentiate ourselves is just the ability, like I said before, to stretch out across the country through the LPC commercial platform. So where I've got a group of 5 guys in Dallas doing data center deals and trying to build a reputation there, Lincoln's got a long-standing 40-plus year history in normal real estate circles. So what it allows us to do is be more efficient in our capital raise. We've had some success raising equity and debt for deals. I think a lot of that is largely dependent on the brand, the Lincoln property brand. And, And then the ability to go execute that business plan is, I think that gives us an edge, because we've got resources in every market that can go manage the facility, play facility manager, help us operate, help us with due diligence and new acquisitions, lease space.
Yeah.
So I think that gives us a bit of an edge just from the larger platform. But then again, you've got younger, smaller groups that are getting into the space today and making waves.
Yeah, well, it's becoming more competitive. But what I do like about Rackhouse is I think you'll have an ability to, from an entrepreneurial perspective, still look at individual opportunities that perhaps some larger providers or companies aren't able to go after because it doesn't necessarily meet their deal parameters.
Right.
And it's probably allowed you to, be able to go and acquire some of the things that you have because you have stuck around the hoop and you have.
We want to, we try to get very aggressive there. I can't go compete with the big boys.
Sure.
I can't go beat Digital and Cyrus One and QTS on deals that they really like.
Yeah.
So we try to focus more on that middle market of enterprises, colo managed services, cloud providers, and we've had some success, frankly. The big guys aren't focused on buying these value-add assets like they once were. It's much more development focused. They're chasing the hyperscale a lot more than they did before, which is, I think, somewhat pushing some of that more enterprise business that they focused on in the past out. So we try to tackle that business as hard as we can.
Yeah.
We focus on the tougher deals that take a little more work and effort, and sometimes it turns into long nights and weekends, but this isn't a 9-to-5 job.
Sure.
And we've had some success. We've leased within our portfolio about 650,000 square feet of data center space and the equivalent of 30 plus megawatts. To that middle market of enterprises, colo, and managed service providers.
There's definitely a market there.
There's still something there. I think we can still make traction. And that segment of the market is still growing.
Yes.
There's still those enterprise companies who are getting out of owned assets.
Yeah.
And that's what we tend to focus on.
Yeah. In 2009 or 10, if someone had come to you and said, hey, we have a requirement for 20 megawatts, it would have, collectively in the industry, it would have blown everybody's mind because that was not taking place back then. And, it's one of the things we've really tried to highlight is the change in with a small group of companies, the demand size, and how that has really impacted the market. I mean, it's really changed it. From your perspective, how has the growth of some of these requirements, these hyperscale type requirements, changed the industry?
I hit on it a bit before. The way it's changed things is just the sheer size of deal that you're seeing get signed.
Yeah.
And it's caused the REITs and the larger operators to kind of focus on that segment of the market.
Yes.
A lot more than they once did.
Yep.
And allow new entrants to step in and service that more middle market outside of the hyperscale. So, it's the demand is staggering, and largely driven by hyperscale and cloud. But, for a group like ours, I wish I could tell you it meant, or it's meant the world to us. I wish I could tell you that they're releasing space from me all over the country, but they're not.
Yeah.
And that's okay.
Yeah.
Because we can focus on those groups that we've historically been focused on and see some success.
Well, and I think it creates, I think it does create opportunities for different players in the middle market range. And, it's one of the things I've talked about before, but, when someone comes and takes, when a data center is being built and there's 10 megawatts of critical capacity coming online, and before it's even built, it's leased. That's a really good thing for the company that leased that data center capacity, but it also creates challenges with the number of smaller companies they do business with that they can't place within that facility right then. And so I think that is creates opportunities for others. And, that's one of the things I think we're seeing not only in Northern Virginia, but Dallas and Chicago and Silicon Valley and Phoenix and Atlanta. And it seems like that's taking place as well.
Another thing it's done to the market is driven pricing down.
Yeah.
So if you look at that larger group of REITs and data center providers
Yep.
who are chasing large hyperscale deals and getting super competitive
Yep.
from a lease rate standpoint. I'd rather those guys go win every hyperscale deal,
Sure.
frankly. Go chase those deals at an 8% return on cost or lower, while I focus on those tougher deals, the more difficult, stories.
Yeah. Tell us about why you like the Dallas data center market.
Dallas is home.
Yeah.
I know this market probably better than any other market in the U.S. Been here in the data center space for a long time. It's in a weird spot right now. As you may know, demand has seemed to lag a bit, but Dallas is one of those markets that's always had a consistent enterprise demand, a consistent colo demand. So I think it's still there. There's some hyperscale deals getting done quietly. Historically, groups like SoftLayer and IBM have been the only major hyperscale to lease large chunks of space here. I think you'll see that change a bit. And then you look at what Facebook and Google are doing here.
Sure.
It's huge. Now they're following the DIY model, right? And that may be the case for other groups behind them. But I really like the market. We made a big play here. We've got a lot of space available here today. And I'm not going to turn away a hyperscale or cloud deal from that space, obviously. But, we're excited about it. I think we've got a great site here that's ready to go day one. And while we're competing with some larger operators, I think we'll see some success.
I was in Phoenix earlier this week, got to walk through, y'all's recent acquisition there. Talk about why you feel like the Phoenix market is, an area you all want to be in for a while.
We were in that market for a very short amount of time with available inventory. Love the market. A lot of press lately. A lot of great facilities in the Phoenix market as well. And we just happened to pick up, I think, what's one of the best ones in that Phoenix market.
Yep.
So fortunately, we were able to get a lease signed maybe, 10 days from acquisition closing, and it all worked out. I'd love to find another value add deal in that market and go do it again. Yeah.
Kansas City, you're there. That's a different market, more of a secondary type location, but there's some interesting things happening there. Talk about that market.
TBD. Kansas City is a market that doesn't have a lot of historical demand information out there. It's one that I don't believe you guys have really tracked a whole lot, and some of the other groups. But we've bought a great facility there, and I'd argue that it's one of the best of the three in the portfolio. I think historically, you've seen a lot of success from the colo operators there. You've got groups like DataBank and LightEdge and Cavern that have consistently filled up large blocks of space. And surprisingly, market rates for data center space there are much higher than some of your top markets that you hear about. So we're excited to bring on a large chunk of space there. Historically, it's been a do-it-yourself market for the enterprise on larger scale builds like State Farm and Centene. And there's there's a surprising number of large enterprises that are headquartered there. So who knows? You've got a government that's willing to incent data center deals into the space. It's a fairly low cost market from a power perspective and just real estate perspective. Low risk in natural disasters. We've got a great building there. So who knows? I think we'll see some success there as well.
Yeah, and let's talk about Northern Virginia very quickly. Just, obviously that's a market you're familiar with, but talk about just your thoughts on that location and what's happening there today.
It's unbelievable, really. I think every conference you go to, Northern Virginia gets all the pub. Every conference you go to, it's all about, the sheer scale of that market and what it's become. You won't hear any different from me. Now, in that market, we barely scratched the surface. We acquired roughly 100,000 square feet across 2 assets. Fortunately, made a great deal going in. Last year, brought in a new operator in Evocative who leased a full building from us, and are fully stabilized there now within a couple of years. Now, we're not chasing the big hyperscale there either. We're not doing a development deal there. I can't compete with the REITs buying $1 million land, $1 million an acre land. But what I can do is go pick up those assets that are existing that have some cash flow in place and find a way to stabilize them. So we did that there. I'd like to make a bigger play there, obviously, but I think we're a little better served focusing on markets that the big boys aren't, just throwing haymakers at one another.
So I want to switch subjects. Which is harder, competing in the data center business or coaching 7-year-old soccer, which you've done, you've got experience in?
So
I'm kidding, but
obviously the data center business.
Talk about,
it's not easy.
But you do coach your girls soccer. Have done that in the past, which is great. Why do you like doing that? What's been fun about that?
Coaching 4 to 7-year-old girls soccer is a ton of fun.
Yeah,
it really is. It's a little challenging, but I'd say it's the best experience I've had on a personal level in a long time.
Yeah.
Got to spend more time with my daughters.
Yeah.
You really like all the kids.
Sure.
Love all the kids. Love, getting them together, seeing them have so much fun with one another, but it comes with its challenges too, that especially at 4 to 5 years old. And, I've had a great time with it. I don't know how long in that game I am, honestly, because I grew up playing soccer very young, but didn't stick with it.
Okay.
And, so the game and the new rules and playing positions has outpaced me
a little bit.
But I can stick with the younger age groups, which is a little more fun for me, I think, before they get into the whole serious, club scene and academy scene.
Yeah.
And, and the parents get a little more aggressive about things.
Yeah, you bet. Well, it's funny, now that you said it, like the 4-year-old soccer, I coached he was now 11-year-old when he was 4 or 5, like beginning soccer matches. And we had a team that, bless their heart, they just, were more interested in what flowers and dandelions were on the field than they were the ball. So as a coach, you're on the field with your team, and so when the other team scores, you get to go and pick the ball out of the net. And so, we had some coaches that had just no mercy on us at all.
Oh, right.
And I remember my wife telling me, I can see your competitive side when you're having to go pick that ball up time after time after time. You guys getting scored on, it's kind of coming out, and you need to just chill out. So it's always good to have a level head when coaching 4 or 5-year-old soccer.
I think we've been beat 15-2 a time or two, but then we've won, some games that were a bit lopsided as well.
Good.
I get a little too competitive with it too, to the extent that, my oldest daughter told me this year that she may want to play soccer again as long as her dad's not the coach. So,
that did it.
I'm going to go focus on the younger one and maybe take a little break.
Yeah,
sit on
the sidelines. There you go.
In a lawn chair.
Yes.
And enjoy my morning.
Yes, that's good. Well, just in closing, when you think about, just being in this space, you've been in it for a long time. You're going to be in it for, years to come. What gets you most excited about the data center industry?
I really like the position we're in today with the Rackhouse platform. I think there's still a lot to be done in this space, and I think we can get more involved in the development side of the business too. Mm-hmm. We're doing a build-to-suit today for a large telco in the Miami market, and I think we'll see more of that. This is a small industry, right? So you've had a ton of guests here. I'm honored to share this mic with them.
You bet.
But we're all friends, and we're all such a small subset of people that all tend to get along and have a good time together. Yeah. And it's just a great fraternity to be in and associate with. So I'm most excited about that. You've got to have fun doing what you do or it's not worth doing it.
You bet. You bet.
So it's just a great space to be in. I'm happy to be here.
Yeah.
I think we all are. Yeah. And excited for the years ahead.
Well, Ryan Sullivan, thank you for joining us. Really fun to get to hear about Rackhouse and what y'all are doing, and wish you nothing but success down the road.
Thanks very much for having me.